This is a very interesting chart shared by FactSet. It shows us the implied S&P 500 price target based on the price target of its individual components, the stocks that make up the index. And the price target, of course, is given by the Wall Street analyst. And based on this chart, the blue line represents the current S&P 500 price, which is at 57.45. And this dash line here is represented by the bottom-up target price based on its individual stock component of the S&P 500. And industry analysts in aggregate predict S&P 500 will have a price increase to 62.87 over the next 12 months. That's about approximately 9.4% increase in the next 12 months. And again, the way they calculated it is by adding up the market cap weighted price target for individual companies that makes up the S&P 500. So pretty much overall, it's a pretty optimistic view of a 9.4% price increase for the index. That's not bad. And at the sector level in S&P 500, same thing, bottom up target price versus the closing price of pretty much today. As we can see in the 12 months, based on the based on the price target, what sector will be performing the best based on the estimate. As we can see, the best ones are energy at 20.5%, communication services 13.5%, information technology at 13.2%, right? That's the most bullish sector by the Wall Street analysts. But on the other hand, the worst one, right, for the next 12-month price target is utility at positive 3.2%, consumer staples at 3.4%. So these are the defensive sectors, and they believe these two defensive sectors are the worst, okay, having the smallest price increase in the next 12 months. But we are seeing a lot of contrasting behavior, meaning that what can be observed from the money market fund, right? Money market fund is like zero risk, almost zero risk place to place your money in there to collect interest rate. So your capital is safe. But you're not taking any risks. Okay, it's a de-risking kind of asset, right? Risk off asset. So despite the optimism we saw in the Wall Street, the price target, there was a massive inflow in the money market fund recently. Okay, so money market fund saw a massive $121 billion inflow last week. Okay, the largest, right? That's last week, and that's the largest since the COVID lockdown crisis, and it's actually bigger than the SVB crisis or the Silicon Valley Bank collapse, right? It's bigger than that. So pretty much, so right now lifting the total asset under management for money market fund to a new record high of $6.424 trillion. Okay, and out of the inflow last week out of the $121 billion inflows, majority of them come from smart money, institutional funds. Okay, so out of 121 billion, $113 billion come from institutional investors or institutional funds. Okay, and that's in the week following the Fed rate cut, the jumbo size cut of 50 basis points. So this is a big contrast compared to what I showed you on the previous chart, telling you how optimism people are, but actually people's action is telling us they're actually pretty cautious. Okay, the institutional investors are cautious. They're seeking for safety during the uncertain times. And let's share something from Mike Wilson, right, the U.S. chief economist for Morgan Stanley. So before we go into that, let's look at the unemployment rate. Right? The latest unemployment rate in the U.S. is 4.2% for the month of August. So in Mike Wilson's latest research, he said in the next 3 to 6 months, the equity performance will be determined more by the labor market data than anything else. So implying that inflation is less of an issue now. And the main focus that's going to drive the equity performance is going to be labor market, or AKA whether the economy is still strong. Okay, And Mike Wilson believes that to justify the current high valuation, labor data and other growth indicators needs to improve. For example, soft landing with growth reacceleration, inflation stabilizing above 2%, and Fed continue to cut rate. Okay, and this is the chart from the report. It shows you that tactical risk reward framework around job data, and the green components are risk on, and the red components indicating risk off. So in this table, on each column, it represents different scenarios of how the labor data is going to play out. For example, the next non-farm payroll data, including unemployment rate, will be released on October 4th, which is this Friday, right? So in the future, it's gonna be based on that, right? Based on the labor market, according to him. And for example, this one says unemployment rate below 4.1%, non-farm payroll above 150K with no downward revision. And this column is unemployment rate between 4.1 to 4.3%, and non-farm payroll at 100 to 150K. No downward revision. And here same here 4.1 to 4.3 unemployment rate, same range 100 to 150K job added, but with some downward revision. Okay, and here we have unemployment going above 4.3% and non-farm payroll below 100K. That would be the worst case scenario. Okay, and the sentiment goes a little bit worse and worse and worse, going towards the right hand side. And on the row, he listed out different monetary policy. Right here we have more than 25 basis point rate cut by year end, and here we have 25 basis point cut by year end. So the top column is more dovish Fed. The bottom column is a more hawkish Fed. Okay, and we can see the color gets more red, going towards the right hand side and bottom side. So it's pretty much saying if it's all green, right? It's like a strong labor, very strong, with very dovish Fed. You can even go low quality cyclical. You can go like you can go small caps. Okay, so like strong early cycle type of vibe, right? But if it's like a regular type of thing, right? 4.1 to 4.3, and you should go for large cap. You should go for quality, right? Like cash flow generators, right? And just quality growth stocks, right? But which is probably his base scenario. And the worst one is you have very bad job report. Okay, people should be preparing for a recession, because in that scenario he's recommending utilities, healthcare, staples. Okay, those are like staple. These are like defensive sectors. So pretty much this is telling us how it plays out depends on the future job data, which is actually a lot of uncertainty. Who knows what's going to happen in the future? Non-farm payroll, right? And that's why we see a lot of defensive positioning or risk-off positioning by the institutional traders or investors. Let me give you an update on the flow of the hedge fund or the smart money. And this comes from Goldman Sachs, from their prime book trading flow for U.S. equity, okay, U.S. equity for the week ending September 26th. And for that week, U.S. equity saw slightly net sold for the week. As we can see, the net flow is over here for U.S. equity over here. Okay, it's a little bit net sold for the week, and where the selling, the macro products saw the largest net buying, which is over here, right? The net buying in 3 months, while the single stock were net sold for the week. Okay, so still a little bit more negative overall for the week. And for single stocks that were net sold for the week, we can see what sectors were being bought and sold. So the hedge funds rotated money out of tech, energy, and financial. So the 5-day net flow is over here for the week. So we have the worst one: technology, energy, and financial. Okay, for the week, and rotated into what? Communication services. And materials. Okay, so communication services, materials over here, and that's what happened in the past week. But on the other hand, there's a lot of inflow in a different market, an emerging market, which is China. We're seeing Chinese equities saw the largest weekly net buy. Okay, again for the same week, right, September 20th to 26th, on the record of the Goldman Sachs record, since 2015. I've never seen this much net buying before on Chinese equity. Of course, the reason why is obvious. There's a lot of headlines about it because it's driven by the Chinese central bank stimulus measures, right? It's including like significant rate cut, and there's reduction to banks' reserve requirement ratios, pretty much releasing a lot of liquidity in the system, and there's liquidity injection to directly stabilize the stock market, right? They can directly buy stocks. That's kind of like the QE, right? That's like the QE of China. They're doing some crazy dovish moves over here, right? So overall, all these data combined, I think the key takeaway is for U.S. equity, it's still cautious optimism. So for investors, I think very important to continue to balance the two. Whatever works for you depends on your situation, right? How much money you have saved up, what are you going to do with your money, what stage of life are you in, right? So based on all that, and what kind of safety net do you need, right? Based on all that, you should choose a balance between the two, right? The equity, risky equity, and safe haven, right? Find the balance between the two. Thank you very much. Bye.